Hello, this is Bennett Tchaikovsky, and welcome to Inventory Part 1 Overview. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Any company names or website references to publicly traded or well-known privately held companies that are used in these presentations are the trademarks and or copyrights of those respective companies. This presentation is copyright 2018 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So, up until now, and the last segments of videos that have been focusing on the introduction to accounting and then on the adjusting entries, we've really only been looking at services or service type businesses, meaning that we perform a service, we're debiting accounts receivable or cash, and we're crediting revenue. Now we are going to be focusing on a little bit more of an advanced topic, and that is going to be the sale of inventory. The reason why we didn't sell inventory previously is because when you're learning accounting, if you're given inventory transactions up front, it can kind of be a little bit more overwhelming. So it's better to be looking at the service concept first and then to go to a retailer. Okay, so a few of the things here is we're going to be focusing on retailers. We are not going to focus on the manufacturing of goods. That will be a subject for managerial accounting. I have separate videos for that. That's when you have accountings like raw materials, factory overhead, factory payroll, work in process, and then finished goods inventory. Also, too, for the part where we're going through in the purchase and selling of inventory, we're going to be using what they call the perpetual method, meaning we're going to be recording transactions as they happen. We will not be using the periodic method where we do everything at the end of the period. However, for inventory costing, which is FIFO, LIFO, weighted average, we will be looking at both the perpetual and the periodic methods. Okay. So when we're looking at the retail chain, and this is just important to kind of understand, is we're focused on retailers who sell to consumers. And we can have, as far as like looking at how this kind of works, there's a lot of different ways that this is really kind of changed. And if you look at here, the first example I have is, of course, it's related to alcohol, which is completely appropriate for these videos. You have a manufacturer who sells to a wholesaler, who sells to a retailer, who sells to consumers. And this is probably one of the better examples because of how distribution works with a lot of different, especially with a heavily state-regulated industry like alcohol sales. So here you've got Jim Beam, which is owned by Suntory. Jim Beam makes great products, but I can't start endorsing that just because we'll be getting into inappropriate things. But Jim Beam, which is a type of bourbon, which is owned by Suntory Spirits, which is out of Japan, they will sell their product. They're the manufacturer. They are the distiller they'll basically manufacture it in Kentucky or wherever they do it. If you want to invite me there, it'd be great. But they're going to basically be manufacturing that in Kentucky. They're then going to be selling, at least locally in Southern California, to Young's Markets. Young's Markets is essentially a wholesaler who is kind of the intermediary, and again, this is mostly because of state law, between the manufacturer and then the retailer. And so the one that I'm using here is High Times Liquor, which is in Costa Mesa. Amazing selection, great pricing, best thing I've ever seen. And so again, when you're 21 and you want to imbibe appropriately and not buy that bottle of vodka at the Rite Aid at 2 in the morning, better place to go. So here they've got the retailers who ultimately sell to consumers. So the manufacturer sells to the wholesaler, right? The wholesaler is then going to be selling it to the retailer, who ultimately sells to the customers. So again, this is kind of a more traditional retail chain. However, the retail chain has significantly changed. Another example would be is if you have a manufacturer who then is selling to a retailer who then sells to consumers. What's an example of this? Costco. So Quaker Oats, I believe it's owned by General Mills. If I'm wrong, I'm sure I'm going to be hearing from somebody, sells to Costco, who's the retailer who then sells to its members or its customers. So here the wholesaler is eliminated and Costco is kind of acting as both the wholesaler and the retailer. Lastly, you get manufacturers who then just sell directly to the consumer. So for example, Costco makes and manufactures something called Kirkland coffee, and that's up in Kirkland, Washington. They're making it and then they're selling it directly at their stores, and their Kirkland coffee is awesome. Okay, so why can inventory be so important to a company? And for a retailer, if you don't manage inventory appropriately, it can be an absolute disaster. For example, if an electronics retailer orders and purchases too much inventory and is unable to sell the inventory quickly, the inventory, basically the retailer, risks having the inventory become obsolete. So say if I ordered 1 million iPhone 7s and I couldn't sell those within a very short period of time. We're now on the iPhone 11. I kind of have lost track of it. iPhone X, I have XII, not really sure. But in any event, right, what ends up happening is that if you order too much of something, it can become obsolete, and it may decline in value beyond what the retailer originally paid for the items. Similarly, if a fashion retailer orders too much inventory and the styles fall out of favor, the same problem arises. The inventory may become obsolete and the retailer may lose money on the items by selling the clothing for less than they originally paid for the items. Conversely, if you're carrying too little inventory, and if something becomes really popular, okay, so if an item becomes extremely popular with a consumer for Christmas, then as a retailer, you risk losing the customer to a competitor. And this has really been especially true with the whole thing in terms of online sales. So again, if you're carrying too little inventory for consumer demand, the inverse can also, impact you because you're going to be losing your future business to a competitor. So when we have an inventory sale, there's two different things that are happening. And the first part of it here is very similar to the way we were recording things for services revenue. So if I walk into a Costco, two things are happening. The first thing that's going to happen is Costco is going to take my cash, and it's usually a lot of it, and records a sale, debiting cash, crediting sales revenue. Then the second thing that's happening, though, is that, think about it, I've got the cart, I've got a bunch of Costco stuff in it, and then once I leave the store, if I have my son with me, I might get a little smiley face on my receipt, but as I'm leaving that store, right, I'm taking my inventory with me. The inventory I just purchased with me. Therefore, Costco has to decrease an asset, which is their inventory, and then they're going to be debiting something called cost of goods sold. So this is a really big difference in terms of what we were originally doing, similar to services revenue. We have to record the revenue, and we're going to do that the same way in which we did for services revenue, debit, cash, credit, revenue. However, over here, we have to show that inventory coming off of our books. So we have to decrease our asset, which we're going to do that with a credit. And then we're going to be debiting an expense of selling, which is called cost of goods sold. So what exactly is cost of goods sold? It's essentially, this is an expense that relates to this, basically to this sale right here. So this sale cost us, in terms of our inventory costs, $450. So again, this is an expense, and it's really that expense of selling those inventory goods. Because remember, when I'm selling services, those are services. I don't record a cost of goods sold for the amount of labor. I would just be showing, sales of basically salaries expense. But here, right, when I'm going through and selling goods, it's very, very different. I have to show the inventory coming off my books and that related expense that relates to the inventory. Okay, let's take a look at some examples. So if I go over here, and I should have done this beforehand, but this is for Costco. And if I look at Costco's financial statements, especially their income statement, I'm going to find up right here, this is for the 12 weeks ended May 12th, 2019. So you've got net sales, membership fees, total revenue. Now, their cost of goods sold is really kind of right here, or their merchandise costs. So these merchandise costs really relate to their net sales. And that's really where that amount here. So basically they sold 33.9 million worth of items. Those items cost them 30.2 million. So get another example. If I go to Amazon, and if I go to Amazon right over here, and I look at their income statement right over here for Amazon. So net product sales were 31.8 billion for the 3 months ended June 30th. The cost of sales for those products were roughly 30.6 billion. So again, the cost of sales for those products are going to be 30.6 billion. Now that I'm looking at it, I would probably want to be looking at this a little bit more closely, because I don't know if some of these cost of sales relate to the services sale, but I'm guessing that the cost of sales here relates to this. But one very clear example that I can show you right here is the Depot, or Home Depot Inc., which is one of my favorite companies to look at for many different reasons. If you're ever looking for fun, take a look at their balance sheet and find out if they're insolvent or not. Right over here, they're not insolvent. It says they buy back a lot of their own stock. So when we come over here to Home Depot, for example, here we've got sales minus cost of goods sold gives you gross profit. So Home Depot is selling 30.8 billion worth of items, and those items cost them 20.4 billion. So again, this is their cost of goods sold. Here it's called cost of goods, cost of sales. Again, we're finding this on the income statement. And why this is really important is because previously in the last examples, we were looking at a single step income statement, or simply revenues minus expenses gives us net income. However, when we are dealing with inventory, it's a little bit different. And the reason why is because who are we making our financial statements for? We are making our financial statements for investors and for third parties. So when they look at our financial statements, they'll be able to assess what's going on pretty quickly. So over here, when I get to a multi-step income statement, right over here, we're going to show this a little bit differently if we are in fact a seller of goods. So we've got here sales revenue minus my cost of goods sold tells me my gross profit. Okay, that doesn't mean disgusting profit. It just means how much I'm actually making on my goods. Less my selling, general, and administrative expenses. And again, those are not costs of inventory, but those are just regular selling, general, and admin costs. It could be insurance. It could be other costs that relate to selling the goods. Then we get to our operating income, other income expense, net income before income taxes, and then our net income after tax. So again, going back up here to our previous example right over here, if I look at Home Depot, right, so I got sales minus cost of goods sold gives me gross profit, selling, general, administrative expenses of roughly 5 billion, depreciation and amortization, and then I'm going to get here to total operating income. Then I have my other my other income and expense. And then I've got my earnings before income taxes, and then my net earnings. So what I'm just showing you right here is just another way of showing, again, every publicly traded company is going to be different, but this is generally the general gist in terms of how we go through and use that multi-step income statement. This is extremely important because this is really where we kind of start being able to show our investors if we're in fact a retailer, right over here. Well, if we're a retailer, our main goal is to be selling goods to consumers. So we've got our revenue from our inventory sales, and then we have the cost of that inventory is then getting us down here to our gross profit. Okay, so that is the end of this very first video. Please don't forget to like and subscribe. And I'll probably be trying to be giving some free stuff away to my YouTube subscribers. So in the form of free CPA review courses. So again, please don't forget to like and subscribe, and I will see you on the next video. Have a great one.